In 2026, the total cryptocurrency market cap has reached approximately $3.2 trillion with daily trading volume between $150 and $180 billion. There are tens of thousands of crypto projects competing for your investment, and the painful truth is that the vast majority of them will fail. Most retail investors lose money in crypto not because the market is rigged, but because they buy based on hype, social media trends, and price action alone. Professional investors and institutions do something completely different. They analyze projects using a structured evidence-based framework before putting a single dollar in. In this video I am going to teach you exactly how to analyze any crypto project like a professional in 2026. I will cover the 7 most important factors that separate genuine projects from hype-driven scams. And I will give you a practical scoring system you can use on any project in under 30 minutes. By the end of this video you will have the exact same analytical toolkit that sophisticated institutional investors use to evaluate digital assets. Let's get into it. The first and most important step in analyzing any crypto project is factor 1, which is white paper analysis. A white paper is the foundational document that every serious crypto project publishes. It explains the problem the project is trying to solve, the technology it uses to solve it, the tokenomics of the native token, and the roadmap for future development. Here is how to analyze a white paper like a professional. Step 1 is to identify the problem being solved. Ask yourself, is this a real problem that actually exists? Is there genuine demand for a solution? Does the solution require blockchain technology, or could it be solved more simply without a blockchain at all? Many weak projects invent fake problems just to justify creating a token. If the problem sounds vague or manufactured, that is a major red flag. Step 2 is to assess the solution. Does the proposed solution actually solve the problem? Is the technical approach credible and feasible? A strong white paper explains the solution in enough technical detail that developers can evaluate it. A weak white paper stays deliberately vague to hide the fact that no real technology exists. Step 3 is to evaluate the tokenomics. Tokenomics means the economic design of the token. How many tokens exist in total? How are they distributed? What percentage goes to the team, investors, and public? What is the vesting schedule, meaning how long before insiders can sell? If the team allocates more than 20% of tokens to themselves with a short vesting period, that is a serious warning sign. A healthy token distribution gives the community a significant allocation such as 40% or more and requires the team to hold their tokens for at least 2 to 4 years before selling. Step 4 is to check the roadmap. Does the project have a clear, specific, and realistic timeline of milestones? For example, delivered milestones include Q1 2024 project launch, Q2 2024 testnet release, and Q3 2024 audit completed. While missed milestones like Q4 2024 mainnet launch and Q1 2025 dApp release show execution problems. A project that consistently misses its own milestones without explanation is not one you should trust with your money. The second critical factor in analyzing a crypto project is the team behind it. In 2026, the team is arguably the single most important predictor of a project's long-term success. Here is how professionals evaluate a crypto team. First, check for real identities. Is the team fully doxed, meaning are their real names and identities publicly known? Can you verify their identities on LinkedIn and other professional networks? Fully anonymous teams are an immediate red flag in 2026. There are legitimate privacy concerns in crypto, but major institutional investors will not fund anonymous teams, and neither should you. Second, examine their track record. Have the team members successfully built and launched products before in crypto or in traditional technology? Have they completed previous projects and sustained user engagement? A team with a proven history of delivery is far more trustworthy than a team with impressive sounding credentials but no verifiable achievements. Third, look for relevant expertise. Does the team have the specific skills needed for what they are building? A DeFi protocol needs developers with smart contract security expertise. A blockchain infrastructure project needs distributed systems engineers. A mismatch between the team's background and the project's requirements is a significant risk factor. Fourth, assess the advisors. Are the project's advisors real, credible, and actually involved? In 2026, many projects list famous names as advisors who have never actually engaged with the project at all. Always verify advisor relationships independently. Fifth, check GitHub activity. Development activity on platforms like GitHub provides a quantifiable measure of ongoing team commitment. A project with consistent code commits, active contributor counts, and regular protocol upgrades signals long-term viability. Conversely, declining developer activity can precede price deterioration and is one of the earliest warning signs that a project is dying. The third factor is on-chain metrics and real usage data, because in 2026 professional investors do not just read white papers and look at websites, they verify actual blockchain activity to confirm that real people are actually using the product. Here are the most important on-chain metrics every crypto analyst tracks: daily active addresses. This tells you how many unique wallet addresses are actively transacting on the network each day. A genuine project with real adoption shows steady or growing daily active address counts. A project with falling active addresses despite rising token prices is showing a dangerous divergence between hype and reality. Transaction volume, how much value is actually being transferred through the network. Real usage shows consistent transaction volume from diverse addresses. Fake or wash traded volume often shows suspicious patterns like large round number transactions from a small number of addresses. Total value locked or TVL for DeFi projects. TVL measures how much capital is deposited in a DeFi protocol's smart contracts. A rising TVL indicates growing trust and adoption. A declining TVL often precedes a token price decline as users withdraw their capital, revenue, and fees generated. This is the gold standard metric in 2026. Does the protocol generate real revenue from real users paying real fees? According to research published in 2026, as the cryptocurrency market matures beyond the $4 trillion total market capitalization milestone reached in 2025, investors are increasingly moving past speculative hype and toward structured valuation methods including revenue-based analysis. A project generating consistent on-chain revenue has real product market fit and is far more likely to survive long-term than one that relies entirely on token emissions to attract users. The fourth factor is tokenomics in depth, because tokenomics is where many retail investors lose the most money, and it is where professionals spend the most time. Here is the complete tokenomics checklist that every professional analyst uses. Total supply and circulating supply. What is the maximum number of tokens that will ever exist? What percentage of those tokens are currently in circulation? A project with a large unlocked supply sitting in team and investor wallets is a ticking time bomb. Token utility. What is the token actually used for within the protocol? Does using the protocol require the token? A token with genuine utility that is required to access the network services has real demand that supports its price. A token with no utility beyond speculation has no fundamental floor. Inflation and emission schedule. Is the token inflationary, meaning new tokens are being created? At what rate? High inflation dilutes existing holders. Many DeFi projects lure users with high yields that are entirely funded by token inflation. When the inflation slows, the yields disappear and the token price collapses. Unlock schedule. When do team and investor tokens become transferable? A large cliff unlock coming in the near future is one of the most reliable short-term price warning signs in all of crypto. Always check the token unlock schedule on Tokenomics.ai before buying any altcoin. Burn mechanisms. Does the protocol permanently destroy tokens from circulation? Token burns reduce supply over time, which can support price if demand remains constant. Bitcoin's 21 million hard cap is the ultimate example of supply scarcity creating long-term value. Governance rights. Do token holders have meaningful voting rights over the protocol's future direction? Genuine governance rights align the interests of token holders with the long-term health of the protocol. The fifth factor is the competitive landscape and market positioning, because no project exists in isolation and understanding the competition is critical to assessing long-term viability. Here is how professionals assess a crypto project's competitive position. First, identify the direct competitors. Who else is trying to solve the same problem? Is the market already dominated by established players with deep liquidity and network effects? A new Layer 1 blockchain competing against Ethereum and Solana in 2026 faces an almost insurmountable competitive challenge. The network effects of existing platforms with millions of developers and billions of dollars in TVL are extremely difficult to overcome. Second, assess the genuine competitive advantage. What does this project do better than its competitors? Is the advantage real and sustainable? In 2026, the most important competitive advantages in crypto are deep liquidity and TVL, developer ecosystem size, institutional partnerships and regulatory compliance, unique technology that cannot easily be replicated, and first-mover advantage in a genuinely new market. Third, evaluate the total addressable market. How big is the market the project is targeting? A project solving a real problem in a large and growing market has far more potential than one targeting a niche with limited demand. Fourth, look for institutional adoption signals. In 2026, with Bitcoin ETFs holding over $100 billion in assets and RWA tokenization approaching $30 billion, institutional adoption has become one of the most reliable signals of a project's legitimacy. Is the project being used by real financial institutions? Is it mentioned in institutional research reports? Does it have regulated custody options available? The sixth factor is community and ecosystem health, because a strong, genuine community is one of the most powerful moats a crypto project can have. Here is how professionals evaluate community strength. First, assess community size versus engagement quality. A project with 500,000 Twitter followers but only 200 likes per tweet has a fake or disengaged community. A project with 50,000 followers and 2,000 likes per tweet has a deeply engaged, authentic community. The ratio of engagement to follower count is far more important than raw numbers. Second, look at developer community activity. How many independent developers are building on the protocol? Are there active grants programs funding ecosystem development? A thriving developer ecosystem means the project is not dependent on a single team and will continue to evolve even if key founding members leave. Third, evaluate the governance participation rate. In projects with on-chain governance, what percentage of eligible token holders actually vote? Low governance participation means most holders are purely speculative and have no interest in the project's long-term direction. High participation means a community that is invested in the protocol's future. Fourth, check for organic community growth. Is the community growing because people genuinely believe in the project, or is growth being driven by paid promotions, token airdrops, and referral programs that disappear when incentives end? Organic community growth is one of the most reliable signals of genuine product-market fit. The seventh and final factor is the macro and regulatory environment, because even the best crypto project can be severely impacted by external forces outside its control. Here is how professionals assess the macro and regulatory context. First, understand the regulatory status in key jurisdictions. In 2026, with the U.S. Clarity Act advancing through Congress, MiCA fully enforced across all 27 EU member states from July 1, 2026, and South Korea implementing new crypto regulations, the regulatory environment has become a critical risk factor for every crypto project. A project that is already compliant with MiCA in Europe and structured for the Clarity Act framework in the US has a significant advantage over projects operating in a legal gray zone. Second, assess the macroeconomic context. According to research published in 2026, fundamental analysis cannot ignore the macroeconomic context. Bitcoin and other major crypto assets have shown increasing correlation with risk assets like the Nasdaq 100 during periods of macro stress. Federal Reserve interest rate decisions, US dollar strength, and global liquidity conditions all directly affect crypto valuations. A genuinely strong project with excellent fundamentals can still fall dramatically in price if the macro environment turns hostile. Third, evaluate the project's resilience to regulatory risk. Is the project decentralized enough to resist regulatory shutdown? Does it have global developer contributions rather than a single, identifiable corporate structure? Projects with concentrated corporate structures and identifiable legal entities in strict jurisdictions carry significantly higher regulatory risk than truly decentralized protocols. So let's bring this all together with the complete professional crypto project analysis framework for 2026. Factor 1 is the white paper. Read it carefully, identify the problem, evaluate the solution, analyze the tokenomics, and verify the roadmap. Factor 2 is the team. Check for real identities, examine track records, verify GitHub activity, and assess advisor credibility. Factor 3 is on-chain metrics. Verify daily active addresses, transaction volume, TVL for DeFi projects, and most importantly, real revenue from real users. Factor 4 is tokenomics in depth. Analyze total supply, circulating supply, token utility, inflation rate, unlock schedule using Tokenomics.ai, and burn mechanisms. Factor 5 is competitive landscape. Identify direct competitors, assess genuine competitive advantages, evaluate the total addressable market, and look for institutional adoption signals. Factor 6 is community and ecosystem. Assess engagement quality, not just follower counts. Evaluate developer ecosystem activity, check governance participation, and look for organic growth patterns. Factor 7 is the macro and regulatory environment. Understand regulatory status in key jurisdictions, assess macroeconomic context, and evaluate resilience to regulatory risk. In 2026, with the crypto market reaching $3.2 trillion in total market cap and daily trading volumes of $150 to $180 billion, the investors who consistently succeed are those who do this kind of structured analysis. Before every investment, not every project you analyze will turn out to be a winner, but by following this framework you will dramatically reduce your chances of losing money on hype-driven projects that have no real fundamental value. If this video helped you, please hit the like button and subscribe to the Crypto Skill for more beginner-friendly crypto education. Drop a comment below and tell me, which factor do you find most difficult to research on your own?